Hi there, Serial Trader here. Let's have a look at the major US indices. And starting off with SPX, we'll have a look at the wave chart here. And alright, so in the previous videos, I was laying out some Fibonacci retracement levels to look for. And being that we had a nice pivot low in place. And since we can count a nice 1, 2, 3, 4, 5 down, for possibly a larger wave 1 or wave A. We were expecting that requisite corrective rally into wave 2 or wave B. And just the overall fib pull from top to bottom. We had the 50% retracement, which was 27.72. We've blown through that. Then the next retracement level was the 618 retracement, which actually coincided quite well with this previous fourth wave pullback, which is also a fairly common area to pull back to in a larger, correction. And that came in at 28.12.03. And okay, so the actual high of this minor wave 4 was 28.16.94. The actual high we put in today was 28.15.15. So just shy of the previous fourth wave extreme, and right in that 618 zone for the Fibonacci retracement. And then of course the retracement of last resort sort of thing is the 786 retracement, and that would come in at 28.68. And that's certainly allowable, especially if this is a wave 2. Wave 2 can retrace up to 100% of the previous impulse wave. So that would be anything up to and including 29.40.91. Now, I would be having some serious doubts as to what's going on here long before we got to that point. But technically, this wave labeling would not be invalidated until that previous all-time high got taken out. Now, I really don't think that that's what we're working here. And ideally, we find a peak here quite soon. It would be almost too perfect if we just found it right here on the 618 and started turning down. But maybe somewhere in between the 618 and the 786, you see that fairly often. And also, that being said, so our moving average convergence divergence, our MACD moving averages here. So they're both moving averages. Yes, we've got to cross up. Sorry. Yes, we've got to cross up with this rally we've had, but the actual moving average lines themselves are well below the zero line. So on the MACD daily, according to that, this is a counter trend move within a larger downtrend, because since these averages are now below the zero line, the trend is considered down. So MACD is telling us that this is a counter trend move within a larger downtrend. And how about RSI? So we know in an uptrend, RSI pulls back to the range between 40 and 50, which is considered RSI bull market support. But in a downtrend, RSI bounces up into the range between 50 and 60, which is considered RSI bear market resistance. So since we are currently in a downtrend here on this daily chart, where have we bounced up to an RSI as of today's strength? Okay, we're sitting around right at 56. So that's right in the range between 50 and 60 as far as the RSI bear market resistance zone. So that's interesting, worth noting certainly. So now that I've done all that, let's dig into a shorter term time frame, look at the actual subdivisions and the development of possibly this wave 2 corrective rally. And okay, so from the bottom, you can definitely get a 1, 2, 3, 4, 5 for A. And I believe I had this labeled in the last video before we started this week. Now, I was anticipating a much, a deeper wave B decline than how it actually unfolded. And ideally, I was looking to maybe fill this gap we made from last week and maybe go into a fib retracement zone, a more common one, maybe the 50 or the 618, but we didn't get down there. It was a shallower pullback for wave B. Let's see, did we do the 382? Yeah, so we basically got right around to that 382 retracement of the overall wave A, as I've labeled it here. So that's certainly acceptable in a B wave. In fact, it almost reinforces it's a B wave, because if it was a deeper retracement, that would be more typical of a second wave. You know, you'd have a 1 up, 2 down, and working a 3 up, which would be more bullish right now. But since we just said that shallow 382 retracement, that's a pretty typical B wave retracement in a zigzag. So we have our ABC down for B. And maybe if I just go to the 15-minute, you'll see more detail. Yeah, okay. ABC down for this wave B, and now we've done a 1, 2. You can get a 3, 4 non-overlapping here, and now we've just gone very strongly up in potentially this wave 5 of C, of the larger 2. So I'm liking that we got a 5, 3, 5, just, you know, plain old zigzag wave 2 on our hands here. And as you can see on this hourly chart, now that I'm on the hourly, our hourly RSI is extremely overbought at this point. Let's see where we're at. Yeah, so we're right around 80 on hourly RSI. So very overbought. If you look at previous times that we've gotten this overbought on hourly RSI, that was obviously a significant peak. You know, it was the peak as of right now. This was a significant peak that led to a good pullback. This was a significant peak that led to a good pullback. So even in the uptrend, when it was still an uptrend, getting to these levels on hourly RSI led to a significant pullback each time. You know, looking back as far as you want. So the bottom line is here, we're going to find a peak fairly soon, and we should at that point start reversing and be looking, I mean, even in the most bullish scenario, which I'm not in the bull camp at the moment, but even the most bullish scenario, we should at least be looking at coming down to close at the minimum today's gap, never mind the gap from last week. So there's that. And what else can I point out here? So on the daily chart, yeah, that's probably good. I mean, one thing that's a little, I mean, it's not surprising where we've gotten to in price. We're certainly expecting a nice corrective rally up into some fib zones here. But what might be a little surprising is just the speed at which we've gotten there. I mean, this overall wave 1 down. Okay, so how long did this take? We started on the 21st of September from that high, and made our bottom on the 29th of October. So over a month to get our 5-wave decline for possibly wave 1 or A. And this wave 2, as far as the time consumed, so we started wave 2 on the 29th of October, and today, I'm not saying it's ended, although it should be soon. Let's say if today it's ended, we're on October 7th. So that's a significantly smaller amount of time consumed than what we did in wave 1. And that makes me a little suspicious that this is just going to be a simple wave 2 up and we go down right away. It could be something that, you know, we have our ABC up for, say, a W, and then we do, you know, XY double zigzag and consume some more time. Doesn't mean we'll necessarily go much higher in price. You know, maybe go up to the 786 on wave Y or something, if that's how it plays out. But yeah, it's just a little suspicious how little time has been corrected. The price correction certainly acceptable and even ideal almost at this point, but the time correction not so much. Although time, it doesn't have to be proportional, but it's just a nice to have. Gives you more confidence on the wave count. Now that being said, before I go to the thinkorswim candlestick chart, let's just pretend this is completely blank. I have no wave labelings. I have no preconceived notions about, you know, where this is going or where I think it's going. Let's just pretend this whole October decline never happened, and we didn't have the worst market, you know, in 10 years for the month of October, something like that. Let's pretend none of that happened, and we're just working off of a typical low from a healthy pullback. It's not a healthy pullback by the looks of it, but from a healthy pullback. And let's just evaluate things on the hourly chart from that level, pretending that we didn't have this massive, you know, scary decline. So what would I be looking at here? Well, if I want to be the most bullish possible, ignore everything I just said. Maybe we have a 1 up. Maybe this is a 2 down. Maybe a 3, maybe a 4, and maybe a 5. And I would still say, oh, we're really overbought on hourly RSI. So even if I'm, completely bullish, we've got, the low of the, the low of the generation in here. And we're just going to skyrocket to well over 3,000 by the end of the year. And that's just the beginning. And next stop, 4,000, 5,000, mega bull. Market always goes up scenario, which is ridiculous, but let's just pretend. I have to humor this side just to, look at both sides from a trading perspective. So if this is the case, and I'm going to force this into a 5 wave up off the bottom, and here we have our acceleration gap in wave 3, and now another, acceleration gap. We're just going to the moon. We still have a 1, 2, 3, 4, 5 up. Looks mature, looks overbought on the hourly. Should peak soon. And in this bullish scenario, we're still going to be looking for a healthy corrective pullback. And if this is a overall, let's say it's a larger wave 1 up, we need a wave 2 down, and then a 3, 4, 5, on and on we'd go. Just bump up the degree there a bit. So if that was the case, we'd still need a healthy wave 2 pullback, maybe between the 50 and the 618 retracement, which would be quite common for wave 2, which would still be a significant decline from current levels. So, a little bearish posture is still warranted even in this extremely bullish bias scenario that I just painted here, which, by the way, I do not think this is what we're doing here. But even if you're this bullish and we're applying the things that we know properly, still calling for some near-term, fairly significant weakness. So from current levels over 2,800, looking into easily over 100-point decline just to have a healthy Fibonacci retracement. Okay, so I'll leave that there. Now this is obviously the chart that I'm favoring, and I think that we're going to have our wave 3 or C decline once we finish our correction up in wave 2 or B. But we'll leave that now where it is. Let's go to the thinkorswim candlestick chart. And okay, so on our oscillator, on our daily oscillator, which has been quite reliable for kind of marking peaks, even in the uptrend, it still marked the peaks quite well. And being that we are in a downtrend now, and this appears to be a corrective rally within the downtrend, it should be also still quite precise for accompanying a significant top. So oscillator getting into the overbought condition. We have this large price gap that's been unfilled since last week, and now another price gap today, currently unfilled, and we're right at that 618 retracement level, also the previous resistance level here, which was that 4th wave. Given all this information, also another thing about these gaps. So if you go back on this chart, and you can go back as long as you want, go back years, find how many gaps don't get filled on SPX. I'll tell you right now, very few don't get filled, and particularly when we have 2 of them in short succession during such a volatile market that we've been in. You can almost rest assured these gaps are going to get tested, especially the one we just did today, and also still likely this one from last week. So that's another contributing factor towards having a kind of a bearish posture here, looking to sell this thing, looking to buy puts. Speaking of which, what did I buy today? I bought some SPY puts. I did not buy a full position. I'm not trying to call the absolute top before it gives me any evidence to do so, but I am trying to average into a bearish swing position. So I bought so far 20 SPY puts expiring on the 18th of January 2019, 290 strikes, so quite deep in the money, and my average price on those currently is 1306. I plan on adding further into that, maybe to get to 50 or 60 contracts. And every time I just see, near-term strength, currently I'm going to, be averaging in to get to that full position size. So that's my game plan there. Just thought I'd share which contracts I'm currently buying into here. And the only thing that would really discourage me and make me want to get out of those would be if we took out, the all-time high at this point. Because again, anything up to, now I don't want to see it do 100% retracement. That would certainly get me questioning things. But anything up to and including the 100% retracement is acceptable in a wave 2. And because those options are so deep in the money, they're almost completely intrinsic value at this point in time. But if we got up to that point, that'd be 290 something on SPY. They would be roughly at the money, and they would still retain, maybe half of their value or thereabouts. So even in the most disastrous scenario where we're just doing a moonshot up to new highs unabated here, you're looking at maybe a 50% loss on those January puts, something like that. And if we're right, and this thing falls apart in a third wave or a C wave, you can be looking at multiples of the original cost. So good risk reward still. Obviously, how much total risk you take is just going to be a product of the position size, and that's going to be different for everyone. All right, so that's SPX. Well, before I go on to the other charts, I'll also mention that just the personality of the waves. So larger degree wave patterns can actually have kind of identifiable personalities as far as what you're hearing or seeing in the market and commentary and that sort of thing. And I believe just last week, so that was, I think, Monday. Was it Monday? Let's see here. Yeah, Monday the 29th of last week, we had our low of this entire decline. All I was hearing, on financial media and commentary was no bottom in sight. We're about to take out the February lows in short order. This market can't catch a bid. It was all doom and gloom bearishness. And that was probably a good sign that, we were close to a bottom, and we were. And now, just a short, week and a bit later, all I'm hearing is bullishness. We're going back to 3,000 by the end of the year. That was just a healthy correction. We're going to the moon. And basically a complete reversal in the commentary and the psychology of what I'm hearing from at least the market participants that have a voice on media. So to me, they were overly bearish near the lows. Now it seems that they're overly bullish in what I think is near the highs of this corrective rally. So sometimes to have a successful, trade, you have to be able to go against the grain, go against what seems to be the consensus. So that's definitely complementing this at this point in time. Okay, I think that's probably good here. I'll also say we have the declining 50-day simple moving average, kind of somewhere between our 618 and 786 retracement for SPX. So that could be another level to look for as far as overhead resistance. Let's see here. We did get above the 200-day moving average and the falling 20-day moving average on SPX. But again, I'm more concerned with these Fibonacci zones here. Okay, we'll go down to the Dow Jones Industrial Average. And what do we have on the Dow? Let's see. I'll get rid of this downward target since we hit those. Let's get rid of that. So we've gone through the 50% retracement level, so I'll get rid of that. On the Dow, we've gone well through the 618 retracement level. So right now we're in between the 618 and the 786 retracement level on the Dow. We're well into the overbought condition on the daily oscillator. So the Dow's looking like it's going to find a peak very soon. Interestingly, how much deeper we've gone as far as retracement goes on the Dow as opposed to SPX. But I imagine we're going to come down, at least test these gaps, or at least this gap, fairly soon. very much in tandem with the other index there. Again, the only thing that could change my mind from my bearish stance on the Dow would be taking out the all-time high at 26,952. And I really doubt that's going to happen. But hey, if it happens, then we have to reevaluate the situation, right? That's just the way it is. Now, let's go to the Nasdaq Composite. And I believe this is still showing some more relative weakness compared to the S&P or the Dow. Okay. So what do I have here? So 50% retracement level. We've just got a little bit past that today. We're kind of in between the 50 and the 618 here on the Dow. Then the 786 is up here. I also have the 618 and the 100% relationship between, you know, what could be A and C. We're close to the 618 relationship between A and C, and then the 100% would come up here in between the 618 and the 786 overall retracement level. We got a little bit past the 200-day moving average on the Nasdaq, and we're not quite in the overbought condition yet on the Nasdaq. So it's had a weaker retracement of the overall decline, but it also had the biggest decline. So that has to be kept in context as well. But still very much the same pattern. Two gap ups, both of which are likely to be tested or closed. You know, even in the bullish scenario that I painted, you know, where we just ignored that we had this significant decline. Even if it's just an initial impulse wave up of a much larger advancing wave up, we still need to have some sort of proportional retracement after having such a strong move off this bottom, right? So that's what we're looking for in the Nasdaq. And how about the VIX? All right, so on the VIX, we've made a lower low below the previous low here, which was at 1706. Today we went as low as 1633. No, the VIX has its 50-day moving average just slightly crossing over its 200-day, and now we're kind of sitting right on that, right on those two moving averages. Whether that means anything or not, whatever. But I would say the VIX is still technically in an uptrend. It's obviously had a strong pullback within its uptrend. So we'll be seeing if VIX can come to life again if we get some equity weakness. If we have a little bit of a pullback on the equities, maybe come fill those gaps, test those gaps, but VIX stays very flaccid, might have to entertain the thought that we have something more significant developing to the upside. But again, I'm not currently favoring that scenario. Okay, so that should be good there. And yeah, we'll update later in the week, see what happens. Definitely looking for at least a short-term top fairly soon. All right, Serial Trader signing off.